Okay, let's go ahead and talk about the second type of intercompany debt transaction, which is going to be referred to as constructive retirement, when one company issues debt into the open market and then the related company comes along and buys it up in the open market. When one firm sells bonds directly to a related party, the consolidation process is simple. We went through that in the previous slideshow. The lender and borrower have the same amount of interest revenue and expense, the same amount of asset and liability. We simply close one against the other. From a consolidated standpoint, the debt never existed. It's much different when one firm buys the debt of a related firm on the open market. Now let's go and assume that Big Company owns 100% of Little. And in 2002, Big Company issues $100,000 of 10% 10-year bonds at 98. Let's assume straight line amortization. A few years later, Little Company buys these bonds on the open market at 103. Now individually, Big still has bonds payable and interest expense on their books, while Little has an investment in bonds and interest revenue on their books. But from a consolidated standpoint, the consolidated entity has repurchased and retired its debt. The consolidated entity should therefore have a gain or loss on retirement, because again, the consolidated entity has repurchased its debt on the open market and retired it. Now let's go ahead and go through with this example. And again, we're going to assume that Big Company owns 100% of Little. Let's assume that on January 1st, 2002, Big Company issues $100,000 of 10% 10-year bonds at 98, and they'll use straight line amortization. On 12/31/06, so 5 years later, Little Company buys these bonds on the open market at 103. First, let's go ahead and compute the gain or loss on retirement. And again, to do that, we're going to compare the book value at date of acquisition with the price paid. So the book value of the debt on 12/31/06, we have the bonds payable at face value, less the remaining discount. Now again, these things initially had a 2% or $2,000 discount. Half of the 10-year life has elapsed, so half of the original discount has been amortized, the other half is still there. So they've got a book value of $99,000. They were repurchased for $103,000, a loss of $4,000. Now this means that on the 2006 consolidated income statement, we have to treat this bond as having been retired at a $4,000 loss. Now this loss is realized but unrecognized on Big and Little's books. Now that's the opposite case from what we've dealt with intercompany sales of assets and intercompany sales of inventory and so on. In those cases, the gain or loss was recognized but unrealized. Now it's realized but unrecognized. It's going to get recognized by Big and Little through their interest revenue and expense, which we'll discuss in a couple slides down the road. So again, a very useful thing to do is to make a list of all of the accounts related to the bond issue on both parties' books at the end of each year. So in 2006, the year of repurchase, Big Company has bonds payable. They've got their $1,000 discount remaining. Again, this is at the end of 2006, 5 years into the bond's term. And they've got interest expense of $10,200. The $10,000 coupon interest, $100,000 face value times 10% coupon rate, plus the $200 annual amortization of the discount. On Little's books, they've got their investment in bonds of $103,000. Little Company doesn't have any interest revenue yet, since they didn't actually buy the bonds until 12/31/06. So at the end of 2006, they don't have any interest revenue yet. Now for the elimination entry, we're going to have to eliminate the intercompany asset and liability and any intercompany interest revenue and or expense. Now there's no intercompany interest in this case. The $10,200 of interest expense Big has incurred was incurred during 2006 when an unrelated party owned the bonds. Again, this became an intercompany relationship on December 31st, so there's no intercompany interest for 2006. So for the elimination entry, what do we need to do? Again, we need to eliminate the intercompany debt and asset. So we're going to eliminate the bonds payable, and we eliminate the remaining discount. We also need to eliminate the investment in bonds that's on Little's books. This doesn't balance. We're missing a $4,000 debit, and that's going to be the loss on retirement of bonds. So again, on the consolidated income statement, we're going to have a loss on retirement of bonds, and the bonds will be removed from Big Company's balance sheet, and the investment in bonds will be removed from Little Company's balance sheet. Now, under the full equity method, which we'll assume for the moment that we're going to be using, Big would reduce their investment income by $4,000 also. Now, upstream versus downstream in these transactions, we assume that the bond issuer, the borrowing company, is the originator of the transaction. So if Big is the issuer of the bonds, we would view this as a downstream transaction. If Little was the issuer of the bonds, we would view it as an upstream transaction. So by reducing investment income by $4,000 under the full equity method, that's going to reduce Big's income and subsequently their retained earnings down to its correct level. Okay, now again, the loss is realized but unrecognized on Big and Little's books. It gets recognized by Big and Little individually via their different interest expense and interest revenue over the life of the bonds. Again, there's a $4,000 loss, and the bonds have 5 years left to run as of the date of acquisition. So the $4,000 is going to be recognized straight line over 5 years at $800 per year. That loss is going to be recognized by the two companies combined having $800 more interest expense than interest revenue. Now, Big Company's interest expense, again, they have their $10,000 coupon interest plus their $200 annual amortization, $10,200 per year. Over on Little's books, Little is the bond buyer, they'll have interest revenue, again, $10,000 coupon interest. They have a $600 premium amortization, which reduces interest revenue. So their interest revenue is only $9,400 per year. Net those two things together, and we have net interest expense of $800. Again, $10,200 interest expense on Big's books, $9,400 interest revenue on Little's books, net difference $800 as a net expense. We can interpret this as Big and Little together recognizing $800 of the loss every year through their disparate interest revenue and interest expense accounts. Now let's go ahead and go on to the second year. Again, let's sort of catalog what Big and Little have on their books related to this intercompany bond issue. Big Company has bonds payable of $100,000. So we have to eliminate that with a debit to bonds payable. Big Company also has a remaining discount on bonds of $800. Again, last year it was $1,000, this year it's $800, next year it's $600, then it's down to $400, then it's down to $200. So that has to be eliminated also. Big Company also has interest expense of $10,200, and now this is intercompany interest. This is interest expense that was paid to Little Company. So they've got $10,200 of interest expense on their income statement. That has to be eliminated by crediting interest expense. Over on Little Company's books, they have investment in bonds of $102,400. Again, their original cost at 12/31/06 was $103,000. During 2007, they amortized $600, getting a $3,000 premium being amortized over 5 years. So their investment in bonds, $102,400, that has to be eliminated with a credit. And they've got interest revenue of $9,400. Again, their coupon interest less that premium amortization. So the interest revenue with a credit balance has to be eliminated with a debit. Now this entry doesn't balance yet. What we're missing is a $4,000 debit. That $4,000 debit is the loss that we had last year. The loss appeared on the consolidated income statement, not the income statement of Big or Little. So we have to go ahead and reestablish or carry forward that loss, and we're going to do that by debiting the investment in Little account. Now, all of the rules we had, in our previous discussions about intercompany sales of depreciable assets, intercompany sales of inventory, and so on, When we carried forward a gain or loss from a previous period, we had two sort of questions we had to answer. First, was it an upstream or a downstream transaction? If it's a downstream transaction, it accrues solely to the parent company. If it's an upstream transaction, it gets split between the parent and the non-controlling interest. This was a downstream transaction, so that entire $4,000 accrues to the parent company. The second question is the type of equity method the parent uses. Under the full equity method, we debit or credit the investment in little to record carrying forward that gain or loss. So again, let's go ahead and just restate what we did in that previous entry. This is the entry for the second year's elimination entries. And again, what we've done is we've carried forward the realized and unrecognized loss of $4,000 by debiting the investment in little account. At the same time, $800 of that is being recognized between big and little by their differing interest revenue and interest expense. That means there's only $3,200 to carry forward to the following year. So again, we've got the same pattern going on if we carry forward the unrecognized portion and recognized part of it, leaving us with a little bit less to carry forward to the following year. So let's go ahead and go to the following year. Again, now we're carrying forward $3,200. So we're going to do the same thing. First, we can sort of visualize what's on big and little companies' books. Big company still has their bonds payable $100,000. That has to be eliminated. Their discount on bonds is now down to $600. Again, it's dropping by $200 per year. Initially it was $1,000, then it was $800, now it's down to $600. And they've got interest expense of $10,200 again. And we're assuming straight line amortization. Over on little companies' books, their investment in bonds has dropped another $600 to $101,800. Again, if you look at the entry at the top of the screen, the investment in bonds credit is $102,400. Now it's $101,800. Again, it's dropping by $600 per year. And little also has interest revenue of $9,400 again, and again that's the same as last year because we're using straight line amortization. And now we're carrying forward $3,200 as the realized but yet unrecognized loss on sale. Sorry, loss on bond retirement.